There are 3 taxes sitting in your retirement that you may not actually owe, and the government will never call you to tell you that. Not a deduction, not a discount. 0. Nothing owed at all, in some cases, on money you've spent decades assuming would get taxed the moment you touched it. One of these is a fear so common it stops people from ever selling the home they've lived in for 30 years, when the actual law says most of them would owe nothing at all. Another is a state-level tax bill that can run into the thousands every single year, purely because of which state you happen to live in, not because federal law requires any of it anywhere in the country. The third is a tax so many people are terrified of that they hire expensive attorneys to plan around a threshold they were never anywhere close to reaching. By the end of this video, you'll know exactly which of these apply to you and exactly which ones you can stop worrying about starting today. Stay with me, because the second one is the one costing retirees the most real money every single year without them ever realizing there was another option. I'm going to say something up front that most financial content won't. A lot of what keeps retirees paying more than they owe or avoiding decisions they should make isn't complicated tax law. It's outdated information sitting in your head from a decade or 2 ago that nobody ever came back to correct. The rules changed, your assumptions didn't. That gap is what this video exists to close. Let's be direct about something before we go further. Not everything in this video is specific to turning 65. 2 of these 3 taxes apply to any adult, at any age. I'm covering them here because they hit retirees the hardest, at exactly the moments retirees face them most: selling the family home, moving states, thinking about what happens to an estate. Knowing where you actually stand changes real decisions, even if the underlying rule isn't age-gated. Some of you are going to hear estate tax and immediately tune out, assuming that's a rich person's problem. Some of you are going to hear capital gains and assume it only applies if you're some kind of investor. Both assumptions are wrong, and they're wrong in ways that either cause needless panic or cause you to skip a genuine planning opportunity sitting right in front of you. Here's a third assumption worth naming too, because it's just as common. Some retirees assume their state's tax treatment of retirement income hasn't changed since they first checked years ago, when in reality several states have overhauled these exact rules within the past 2 or 3 years alone. If the last time you looked into any of this was more than a couple of years ago, treat everything you think you know as worth rechecking, not a settled fact. Here's the pattern worth naming. Nobody in government is incentivized to walk up to you and say, "You don't actually owe this." The tax code doesn't work that way. It sits there, silent, and the only people who benefit from you knowing the exemptions exist are you and your family. Nobody else has a reason to tell you. So here's how we're doing this today. 3 taxes, 1 at a time, no padding, no hedging, where the answer is actually simple: what the rule really says, who it really applies to, and exactly what to check in your own situation before you assume anything. Tax 1, state income tax on your retirement. Just why? Let's start with the one that costs the most real recurring money every single year, forever. Whether your state taxes your Social Security, your pension, or your IRA withdrawals depends entirely on where you live, not on any federal rule, and the difference between states is brutal. 9 states charge 0 state income tax at all. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live in any of those 9, your pension, your Social Security, your IRA withdrawals, every dollar of retirement income is completely free from state taxation, permanently, with no exceptions. Stop and notice what that actually means in practice. It's not a deduction you have to remember to claim, not a form you have to file every year, not a threshold you have to stay under. If you live in one of those 9 states, the exemption simply exists automatically for every single dollar of retirement income you'll ever receive there. That's about as close to a set it and forget it tax benefit as anything in this entire video. 4 more states go further than most people expect. Illinois, Iowa, Mississippi, and Pennsylvania all fully exempt retirement income from state tax, even though they do tax other kinds of income like wages. And starting with the 2026 tax year, Michigan joins that list too, with qualifying pension and retirement account income fully exempt from Michigan income tax. On top of that, 41 states and the District of Columbia don't tax Social Security benefits at all. West Virginia just finished eliminating its Social Security tax entirely, effective January 1st, 2026, completing a 3-year phase-out. Only a handful of states, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, still tax Social Security in some form, and most of those offer exemptions once your income drops below a certain threshold. Here's why this deserves to be called a tax you no longer owe, rather than just trivia. Where you live in retirement can mean a difference of $3,000 to more than $10,000 a year in after-tax income, purely based on state tax treatment. That's not a one-time number. That's every single year for the rest of your retirement, compounding across decades. Think about what that actually compounds to. $10,000 a year over a 20-year retirement is $200,000. In dollars, you'd have kept simply by living somewhere with a different tax code, not by earning more or saving harder. Nobody frames it that way because moving states sounds like a bigger decision than claiming a deduction, but the dollar impact can dwarf almost everything else on this list. I also want to be direct about the nuance here, because oversimplifying this would do you a disservice. Not tax on Social Security and not tax on pensions are two different lists that don't perfectly overlap. Oregon, for example, doesn't tax Social Security but fully taxes pensions. Connecticut exempts Social Security below a certain income threshold but still taxes pension income. You genuinely have to check both categories separately for your specific state, rather than assuming one favorable answer covers your entire retirement income picture. The action step here is blunt. If you live in a state that taxes retirement income and you have any flexibility about where you live, this is worth running the actual numbers on, not just assuming it doesn't matter. And if you're staying put regardless, at minimum, confirm your specific state's exemption thresholds for pension and Social Security income, because several states changed these rules within the last year alone, and the numbers you knew 5 years ago may already be outdated. Quick mention before we go further. Everything in this video ties back to a pattern we cover in detail in the Senior Exemption Guide 2026, normally $97. Stay to the end and I'll hand you a voucher worth $50 off, bringing it down to $47. Links below. Now let's talk about the tax that scares more retirees than it should. Tax 2, the estate. Tax that almost nobody actually owes. Here's a fear I hear constantly, and it's almost always unfounded. Retirees worry about the estate tax, sometimes obsessively, hiring attorneys and restructuring assets to avoid a tax bill they were never within a million miles of owing in the first place. Here's the actual number. The federal estate tax exemption for 2026 is $15 million per person. $15 million. A married couple, using portability between spouses, can shelter up to $30 million combined. This is a permanent number now, made permanent under the One Big Beautiful Bill Act, signed in July of 2025, and it's indexed to rise with inflation starting in 2027. Read that again. Your estate has to exceed $15 million as a single person before the federal government takes a single dollar in estate tax. For the overwhelming majority of retirees watching this video, that threshold isn't close. It isn't a planning concern. It's simply not a tax they will ever owe. Here's some context that makes this number even more striking. This wasn't always the case, and it wasn't always guaranteed to stay this high. The exemption had been scheduled to roughly cut in half at the end of 2025, dropping back towards $7 million before Congress intervened and instead raised it permanently to $15 million under the One Big Beautiful Bill Act. That means the number didn't just stay high, it got significantly higher and more secure than what anyone was planning around just a year or two ago. Think about how disproportionate the fear around this tax has always been compared to who it actually touches. Estate tax anxiety shows up constantly in retiree conversations, in financial seminars, in direct mail advertising, expensive trust structures. Meanwhile, at a $15 million exemption, only a very small number of estates nationwide are large enough to owe anything at all. The fear is loud. The actual exposure for almost everyone hearing that fear is essentially zero. I want to be precise here, because there is one real exception worth knowing. A number of states impose their own separate estate or inheritance tax, often at thresholds far lower than the federal number, sometimes as low as $1 or $2 million. That's a completely different tax at the state level, and it's worth checking specifically if your state is one of them. But the federal number, the one that generates the most fear, simply doesn't apply to almost anyone in this audience. The action step is simple, and it's mostly about relief rather than action. If you've been losing sleep or paying an attorney over federal estate tax planning without ever running the actual numbers against the $15 million threshold, stop and run them. For most people, this conversation ends the moment you see how far away that number actually is. Tax 3. The home sale myth that keeps people trapped in houses too big for them. Here's the one I actually think does the most quiet damage, because it isn't just a misunderstanding, it's a myth that actively stops people from making a decision that would improve their life. A huge number of retirees believe that selling their home after 55 triggers a massive capital gains tax bill, and that belief alone keeps people locked into homes that are too big, too expensive to maintain, and too far from family for years longer than they need to be. Here's where that belief actually comes from. And it's worth knowing the history because it explains the confusion perfectly. There used to be a real rule called the over 55 home sale exemption. letting homeowners over 55 exclude up to $125,000 of gain one time on the sale of a primary residence. That rule is dead. It was repealed in 1997, replaced by something completely different and far better for almost everyone. Under current law, Section 121 of the tax code, any homeowner at any age can exclude up to $250,000 of gain on the sale of a primary residence or $500,000 for a married couple filing jointly. No age requirement, no one-time use limit the way the old rule worked. Just 2 years of the last 5 spent living in the home as your primary residence, and the exclusion applies. Here's the detail that should genuinely change how people think about this. The old rule people are still half remembering capped out at $125,000, one time only for people over 55. The current rule offers double that, $250,000 to literally anyone, and up to $500,000 for a married couple. The myth in people's heads is worse than the actual law. The real rule is better than what most people think they're missing. Let's put real numbers to this, because abstract dollar figures don't hit the same way as an actual scenario. Say a couple bought their home in the 1990s for $100,000, and it's worth $600,000 today. Their gain, before any improvements factored in, is $500,000. Filing jointly, their exclusion covers the full $500,000, meaning they walk away from that sale owing $0 in federal capital gains tax on a $500,000 gain. That's not a hypothetical edge case. That's an extremely common scenario for anyone who bought decades ago in a market that appreciated normally over time. Now compare that to what the old dead rule would have given the same couple if it still existed. $125,000 once, and only if one of them happened to be 55 or older at the time of sale. The current law isn't a consolation prize for losing a better, older benefit. It's a meaningfully larger benefit, available to everyone, that happens to have replaced a smaller one that only existed for a narrower group. There's one more piece worth knowing specifically for this audience. If your spouse passes away and you sell the home within 2 years of their death without remarrying, you can still claim the full $500,000 married exclusion, as though you were still filing jointly, even though you're now filing as a single person. That's a real specific protection built into the law for exactly this situation, and it's rarely mentioned anywhere. This detail matters more than it might seem at first, because the timing of a home sale after losing a spouse is often exactly when people are least equipped to research obscure tax provisions. A surviving spouse dealing with grief, and often a sudden need to downsize or move closer to family, could easily assume their exclusion dropped to $250,000 the moment their filing status changed. Knowing that 2-year window exists and that it preserves the full married exclusion can change the timing decision entirely, especially for anyone weighing whether to sell quickly or wait. The action step here is to actually run your numbers before assuming you'll owe anything. Take your home's current market value, subtract what you originally paid plus the cost of major improvements over the years, and see where that gain actually lands relative to $250,000 or $500,000. For a huge share of retirees, especially those who haven't owned in the hottest coastal markets for decades, that gain simply doesn't cross the line at all. One more thing worth knowing about what counts toward reducing that gain. Major capital improvements, a new roof, a kitchen renovation, an addition, all get added to what you originally paid, which lowers your taxable gain further. Keep records of major home improvements over the years if you haven't been, because those receipts directly reduce what you'd owe if your gain ever does exceed the standard exclusion. I want to be straightforward with you here, the way I try to be in every video on this channel. The Senior Exemption Guide 2026 is not an estate planning tool, and it's not a capital gains calculator for selling your home. If that's specifically what you need, that's a conversation for an estate attorney or a tax preparer running your exact numbers, not something this guide claims to replace. Here's the honest reason it's still worth mentioning here. The guide's core focus, state-by-state property tax relief and the new federal senior deduction, connects directly to the same theme running through this entire video. Money the law already lets you keep, that nobody proactively tells you about. If Tax 1, the state income tax question, hit home for you, the guide's property tax chapter covers the other side of that exact same coin, what your state and county already let you keep on your home itself. The guide is normally $97, and the $50 voucher I mentioned earlier still applies, bringing your total down to $47. Stay with me a little longer because I'm about to give you that code. Let me walk you through someone I'll call Robert, 72, sitting in a 4-bedroom house he and his late wife bought decades ago, now worth far more than he ever imagined it would be. His wife had passed away almost 6 years earlier, well outside the 2-year window we just covered for claiming the full married exclusion as a surviving spouse, so his situation runs on the standard single filer rules. For 3 years, he'd avoided even looking at listings, convinced that selling would trigger a tax bill large enough to eat his entire down payment on something smaller. Robert's fear wasn't irrational, it came from somewhere real. A neighbor had mentioned years earlier that people used to get a special tax break for selling after 55. And Robert had assumed, reasonably enough, that if a special break used to exist, its absence now must mean things had gotten worse, not better. Nobody ever corrected that assumption, so it simply sat there, unquestioned, quietly shaping a major life decision for years. When he finally ran the actual numbers with a tax preparer, the picture looked nothing like what he'd assumed. His gain fell comfortably under the $250,000 single filer exclusion, meaning he owed nothing in federal capital gains tax on the sale at all. Separately, he discovered his state was one of the 9 that charges no state income tax whatsoever, meaning that the pension and Social Security income he'd been planning around for years had never been taxed at the state level in the first place, something he genuinely never confirmed until that conversation. Robert sold the house within 4 months, moved into something smaller near his daughter, and kept every dollar of the gain, exactly as the law allowed. Nothing about his situation was unusual or required special planning. He simply hadn't known the actual numbers, and had spent 3 extra years in a house too big for him because of a rule that stopped existing in 1997. Robert later said the hardest part wasn't the paperwork or the sale itself. It was the 3 years of unnecessary hesitation beforehand. A single conversation with a tax preparer, one he could have had years earlier, would have told him everything he needed to know in under an hour. The lesson he took from it wasn't really about taxes at all. It was about how expensive it can be to keep operating on an assumption nobody ever bothered to check. Here's your code, as promised. Understanding which taxes you genuinely don't owe, your state's actual treatment of retirement income, the real federal estate tax threshold, and the real home sale exclusion rules is about making decisions based on the actual law instead of decades-old rumors and fear. The Senior Exemption Guide 2026 won't calculate your specific capital gain or draft your estate plan. That part belongs with the right professional. But it walks through the state-by-state property tax relief and the new federal senior deduction in full detail, the exact numbers and forms for where you live, all in one place. It also comes with a money-back guarantee, so there's no risk in trying it. The guide is normally $97. Use the code SENIOR26 at checkout and $50 comes off immediately, bringing your total down to $47. The link is right below this video. Click it, add the guide to your cart, and enter SENIOR26 before you check out. Here's the question I want to leave you with. How many decisions have you already made or avoided making based on a tax rule that either changed years ago or never applied to you the way you assumed? For most people watching this, the honest answer is at least one, and it's usually the home. Click the link below, use the code SENIOR26, and get your copy of the Senior Exemption Guide 2026 for $47 before you close this video. Recap. Let's walk through what we covered before we close. State income tax on retirement income varies enormously, with 9 states charging none at all, 4 more fully exempting retirement income specifically, and 41 states leaving Social Security untouched entirely. The federal estate tax exemption sits at $15 million per person for 2026, $30 million for a married couple, a threshold the overwhelming majority of retirees will never come close to reaching. And the home sale capital gains exclusion, $250,000 single, $500,000 married, has no age requirement at all, despite the persistent myth left over from a rule repealed in 1997. None of these require you to do anything complicated. They require you to actually check the current numbers against your own situation, rather than operating on assumptions that may be decades out of date. Notice something these 3 taxes have in common beyond the dollar figures themselves. Every one of them got worse in people's heads than they actually are in the law, either through outdated memory of a rule that no longer exists, blanket fear of a threshold nobody's close to, or simply never checking a number that changed recently without anyone announcing it. The fix, in all 3 cases, isn't complicated planning. It's just checking the actual current number instead of the one sitting in your memory. Here's what to do this week. Confirm exactly how your specific state treats your pension, your Social Security, and your IRA withdrawals, since several states changed these rules within the past year alone. If you've ever avoided selling your home out of fear of capital gains tax, sit down and actually calculate your real gain against the $250,000 or $500,000 exclusion before assuming anything. And if estate tax anxiety has ever driven a financial decision for you, run your actual numbers against the $15 million threshold before spending another dollar planning around a tax you likely don't owe. If you're weighing a move to a different state specifically for tax reasons, don't stop at income tax alone. Property tax rates, sales tax, and the overall cost of living in a new state can offset or even outweigh income tax savings, so run the full comparison rather than chasing a single favorable number in isolation. A state with no income tax but high property taxes and a high cost of living isn't automatically the better financial move, even though the headline, no income tax, sounds appealing on its own. And if you've been putting off a conversation with a tax preparer, specifically because you assumed you already knew the answer, that's exactly the conversation worth having first. A single hour with a professional, armed with your actual numbers instead of decades-old assumptions, tends to resolve more uncertainty than months of worrying about a tax bill that may not exist at all. 3 numbers, checked once, against your actual situation. That's the entire distance between decisions driven by outdated fear and decisions driven by the current law. If you have adult children who will eventually inherit from you, or who are helping you make decisions about your home or your finances, loop them into this too. A surprising number of the outdated assumptions floating around retirement households didn't originate with the retiree at all. They got passed down from a well-meaning adult child repeating something they heard once, years ago, without ever checking whether it was still true. If this video corrected something you believed was true, share it with someone else sitting on a decision they've been avoiding, especially if it's about selling a home. Subscribe, because we're continuing to track these thresholds as they change every year. I'll see you there. One last thought before you go. The tax code isn't designed to be intuitive, and it isn't designed to notify you when something changes in your favor. That's not a conspiracy, it's just how the system works, and it means the responsibility for staying current falls entirely on you. Every few years, at minimum, it's worth revisiting the numbers you think you know, because the version of the law sitting in your head may already be years out of date, quietly costing you decisions you didn't need to avoid. This video is general educational information, not personal legal or tax advice. State tax treatment, estate tax exemptions, and capital gains rules can change and vary by individual circumstance. Confirm your specific situation with a qualified tax professional or estate attorney before acting on anything covered in this video.